Most market moves look obvious only after they're already done. In the moment, they usually feel confusing, messy, and easy to dismiss. What silver just did falls exactly into that category. It didn't slowly build momentum. It didn't give everyone time to get comfortable. It accelerated, pushed past price areas that were expected to hold, and forced the market to react instead of analyze. When that happens, focusing on the price alone misses the point. The important question isn't how fast silver moved or how far it ran. It's why the move happened now and who was already positioned before the move became impossible to ignore. It's easy to assume this is just another short-lived surge. Silver has trained people to think that way over the years. But this move isn't happening in isolation. It's happening at a moment when pressure is building across politics, monetary policy, supply security, and global confidence all at once. And when those forces start lining up, metals tend to respond before the broader narrative catches up. Gold and silver are coming off a week where uncertainty didn't fade and risk didn't calm down. Markets didn't get clarity. They didn't get reassurance. In environments like that, capital doesn't wait for perfect explanations. It moves. Gold pushed into new highs and held them with little resistance. Silver expressed that same pressure differently. It moved with urgency, breaking into the 90s and continuing higher, in a way that forced attention even from people who normally ignore metals. Whenever price moves aggressively, people look for a single explanation: inflation, geopolitics, technical breakout, speculation. In reality, major moves almost never come from one cause. They happen when multiple pressures line up at the same time. This week, one of the most important pressures came from growing tension around monetary authority and political influence. When markets see public conflict around central banking, legal pressure, or leadership changes, they don't just think about interest rates. They think about trust. They think about whether policy decisions are driven by data or by control. Even the perception that monetary policy could shift direction under pressure is enough to move capital today, not later. And when confidence in policy starts to wobble, assets that don't depend on promises become more attractive. That pressure alone would have supported metals, but it wasn't the only factor at work. Geopolitical risks remained elevated, with several regions showing signs of escalation rather than resolution. Markets don't need certainty to react. They react to risk. When uncertainty rises, capital looks for assets that are liquid, durable, and trusted across borders. Gold absorbs that demand almost instantly. Silver follows, but it does so in a more volatile way because it plays two roles at once. Silver acts as a monetary metal when confidence weakens, but it's also a critical industrial input when supply chains matter. It's used in energy systems, electronics, and advanced manufacturing. That dual role is why silver can stay quiet for long stretches and then suddenly move with speed and aggression. When investment demand and industrial demand start pulling in the same direction, price doesn't move politely. There's also a policy shift developing quietly in the background. Silver has been labeled a critical material, and that designation changes how governments and companies think about it. Once supply security becomes part of the conversation, demand isn't just speculative, it becomes strategic. Even when immediate policy action is delayed, the signal is clear. Access to supply matters. This ties directly into one of the most important developments happening beneath the surface: physical delivery. A growing number of large, well-funded participants are choosing to take actual metal instead of rolling paper contracts forward. That's not normal behavior in futures markets. Most participants never intend to touch the metal. When delivery demand increases consistently, the market can no longer ignore inventory. And this behavior isn't limited to one region. It's showing up in places that historically relied heavily on paper settlement. That leads to a simple but uncomfortable question. If the strongest players with the deepest pockets are insisting on physical silver, what do they see coming that isn't obvious yet? This is where silver's recent breakout becomes more than a technical event. Price levels in the low 90s matter because they're psychological. They're crowded with stops, short positions, and automated triggers. When price pushes through them, it often creates a chain reaction. Shorts cover, momentum buyers enter, algorithms flip, but those reactions only sustain if there's real demand underneath them. What makes this moment different is the environment around it. Political noise is loud. Trust in institutions is being tested. Supply chains are under scrutiny, and silver is breaking out inside that environment, not during a calm and stable period. That doesn't guarantee a straight line higher. It guarantees volatility, and volatility is the fuel for major moves in both directions. It's important to stay grounded here. Silver can correct sharply. It can move fast in both directions. That doesn't automatically mean the underlying story is broken. Corrections clear leverage. Collapses break fundamentals. Knowing the difference is more important than guessing the next move. The biggest mistake people make with silver is reacting emotionally instead of structurally. They watch the screen but ignore behavior. They follow headlines but miss delivery trends and policy shifts. And they let short-term volatility force decisions they never planned to make. The real question isn't whether silver will pull back. The real question is whether the forces pushing it higher remain in place when it does. If political uncertainty stays elevated, if supply security remains a concern, and if physical demand continues to assert itself, then volatility isn't a warning sign. It's part of the process. Silver has a habit of testing patience before rewarding conviction. Understanding that doesn't make the ride smooth, but it does make it survivable. And in markets like this, survival is what keeps you in the game long enough to benefit from the move everyone talks about later.